Most people think the difference between poor people and rich people is how much money they make. But that's actually not true. Here's the thing. There are people making $30,000 a year who slowly become wealthy. And there are people making $300,000 a year who end up completely broke. Same country, same economy, same opportunities, but totally different outcomes. So what's the real difference? Well, it comes down to one habit. A habit so small that most people ignore it. Yet this one behavior determines whether someone builds wealth or stays stuck financially for decades. And it's this. Poor people spend money. Rich people invest money. Now that sentence sounds simple, almost too simple. But when you actually break down how this works, the math behind it, the psychology behind it, and the real data behind it, you start to realize something shocking. Because the biggest financial problem most people have isn't income, it's behavior. And today, we're going to break that down. Chapter 1. The spending trap most people live in. Look, the average person believes a simple formula about money. They believe make money, spend money, enjoy life. And that sounds reasonable. You work hard, you earn a paycheck, so naturally you spend it. Rent, food, phone, car, entertainment, maybe a vacation. And by the time the next paycheck arrives, most of the previous one is gone. Now here's the interesting part. According to data from the U.S. Federal Reserve, about 37% of Americans cannot cover a $400 emergency expense with cash. Think about that. Almost 4 out of every 10 adults would struggle to pay a $400 emergency, even though millions of them are working full-time. So clearly, this isn't just about income. Because the same research shows something fascinating. Many of those people earn middle-class salaries, which raises a very uncomfortable question. If people are making decent money, where's it going? Well, this is where it gets really interesting. Because according to the Bureau of Labor Statistics, the average American household spends money roughly like this. Housing, 33%, transportation, 17%, food, 13%, insurance and healthcare, 11%, entertainment and lifestyle spending, 9%, and then a long list of smaller categories. But here's what most people don't realize. Many of these categories expand automatically as income rises. This is something economists call lifestyle inflation. Chapter 2. The lifestyle inflation problem. Look, when most people get a raise, they don't invest it. They upgrade their life. Better apartment, new car, better phone, more expensive restaurants. And suddenly, even though they're earning more money, they still feel broke. Now you might be thinking, okay, but that's normal. If you earn more, shouldn't you enjoy it? Sure, to a certain extent. But here's where the problem begins. Let's say someone earns $3,000 per month. They spend $2,900. That means they save $100. Now they get a promotion. Their income becomes $5,000 per month, but instead of saving the difference, they upgrade their lifestyle to $4,900 per month. New apartment, car payment, better furniture, more subscriptions, and guess what? They're still saving $100. Different income, same financial outcome. And this happens to millions of people. In fact, a study from the National Bureau of Economic Research found that most income increases are absorbed by lifestyle increases within 2 years, meaning people don't actually become wealthier, they just become more expensive versions of broke. Chapter 3. The Investor Mindset. Now let's compare that to how wealthy people behave. And no, I'm not talking about billionaires. I'm talking about ordinary millionaires. Because according to research summarized in The Millionaire Next Door by Thomas S. Stanley and William D. Denko, most millionaires in America are not flashy. They're not celebrities, they're not influencers, they're not lottery winners. They are usually small business owners, engineers, accountants, teachers, contractors, people with normal incomes. But they follow one rule consistently. They invest before they spend. Now that sounds simple, but the long-term math is extraordinary. Let me show you something. Chapter 4. The $500 investment example. Let's say 2 people start working at age 25. Both earn the same salary. Both receive the same raises. Both live in the same city. But they make one different decision. Person A spends an extra $500 per month. Person B invests $500 per month into a basic stock market index fund. Historically, the S&P 500 has averaged roughly 10% annual returns over long periods. So let's do the math. $500 per month invested for 40 years at 10% annual growth. That becomes roughly $2.6 million. Now think about that. Not from starting a company, not from winning the lottery, not from becoming famous, just from investing $500 per month. Meanwhile, person A spent that same money on restaurants, car upgrades, clothes, gadgets, things that lost value within months. Same income, completely different result. And this is where real wealth begins to separate people. Chapter 5. The Psychology of Spending. Now here's what most people don't realize. Spending isn't just about money, it's about psychology. Because human brains are wired for short-term rewards. Buying something new releases dopamine, that little excitement you feel when you buy a new phone or a new outfit or order something online. That's not random, it's chemistry. And companies understand this perfectly. That's why billion-dollar corporations invest heavily in behavioral psychology. In fact, companies like Amazon and Apple spend billions studying how to make purchasing feel easier and more satisfying. One-click checkout, free shipping, beautiful packaging, all designed to make spending feel effortless. But investing feels boring, slow, sometimes even uncomfortable, because the reward is years away, and that's the real challenge. Chapter 6. Now you might be thinking, okay, but investing is risky, and that's a fair concern. Markets go up, markets go down. But here's something fascinating. According to historical data compiled by Morningstar, over any 20-year period in modern history, diversified stock investments have almost always produced positive returns. Meaning the real risk often isn't investing. The real risk is never investing at all. Because inflation quietly destroys spending power over time. For example, $100,000 today does not buy what it did 20 years ago.